Welcome and thank you for joining our Expat Tax webinar and the virtual launch of the second edition of Expatriate Tax. I'm Sarah Powell-Wilson, I'll be your host today. I'm a content manager at LexisNexis and I specialize in tax and financial services content. Our panelist today is Jean du Toit from Tax Consulting. Jean, together with his team of authors from Tax Consulting, is responsible for making the new edition of Expatriate Tax available to us all. Please allow me to share a few housekeeping rules and the planned program, which you'll see on your screen as well. So all delegates will be muted for the initial presentation until we move on to the Q&A session. Please send your questions for Jean through on the Q&A tab at the bottom of the screen. The chat box is reserved for general comments that are not questions you'd like to raise with our speakers. The webinar will be about 40 minutes in length and will be made available to all of the delegates a few days after the session. Tax. So LexisNexis published the first edition of Expatriate Tax in 2019. It was a huge success. And some of the important changes covered in the second edition are the phasing out of the formal immigration through the SA Reserve Bank and the new process for those withdrawing retirement interests when they cease South African tax residency. It also deals with changes to the taxation of remuneration earned by South Africans employed outside of South Africa. Jean and the team at Tax Consulting are to be congratulated on getting this new edition to print in an extremely challenging year. It is an invaluable guide to an increasingly complex set of tax challenges. And as Judge Davis says, it is essential reading for anyone advising his or her client with regards to the tax consequences of and non-resident accruals. The book is over 900 pages, so I could go on and on, but if you haven't already done so, I urge you to get a copy of this indispensable work. We have an early bird discount on our e-store if you order before the 15th of November. So please have a look in the chat box for our bookstore address. It is now my pleasure to introduce our speaker. Jean du Toit is an admitted attorney with experience in tax litigation, where he represented SARS and high-value tax disputes. He's the head of tax technical at Tax Consulting South Africa and currently represents major clients across a wide range of industries, specializing in cross-border taxation, corporate restructuring, employees tax, tax disputes, advance rulings, and other technical taxation matters. Jean regularly makes technical submission to National Treasury on legislative amendments and policy formulation. Thank you, Jean. Over to you.
Perfect. Thank you, Sarah, and thank you so much for the introduction. I'll share my screen in a moment. Before we start though, can I ask that everyone just complete the poll? I think that will be shared with you on your screen. Let me just get my slides ready. Okay, so let me just. Okay, so what I did was I had a look at the questions that we received from our clients and from other practitioners in dealing with the most pertinent amendments that came about in recent times, which obviously is the phasing out of the formal immigration process through the South African Reserve Bank. And although the effective date of the amendment to the foreign employment exemption came about in 2020, we still receive a lot of questions in dealing with the practical aspects of those changes. We will also briefly discuss the proposed exit tax on retirement interest, which may or may not come into effect next year on 1 March. And we'll also run through a couple of amendments that has recently come into effect and also specifically after the publication of the first edition. And we'll also look at or briefly mention a couple of cases that were published since the first edition. So in dealing with the first topic for today is the amendment to the foreign employment exemption. Now I'll accept that everyone knows what happened. The initially it was deleted in its entirety, and then a limitation of 1.25 million rand was enacted on 1 March 2020. But for purposes of our discussion, we'll only look at the practical issues that resulted from the amendment. And this is also where I drew questions from clients of ourselves, and also certain practitioners where they have questions from their clients. So the first issue, and by far the question we receive the most, is regarding double taxation. As we all know, that generally where a person performs services in a foreign country, unless the person spends less than 6 months in the host country, both countries will have the right to tax the remuneration. The exception of 6 months doesn't apply in this case, because as we know, then the person would not meet the days test of 183 days in aggregate. So in general, the employee might be subject to double taxation. The employee may claim relief domestically under Section 6 Quad, or they may revert to the treaty, but in most cases, they'll look to the domestic relief provided. It is important to note that the Section 6 Quad credit, and this is where we see a lot of confusion, is only applicable to remuneration that was taxed in both countries. In other words, the tax that was levied in the host country, in other words, the foreign country, on the first 1.25 million rand would not be subject to a credit. So that's just an important note there. And as we know, the credit only takes effect, or you can only claim the rebate upon submission of your return, which then potentially results in cash flow issues for the employee. And this then brings us to what you can do to resolve that issue. Paragraph 10 of the 4th schedule allows the employer to apply for a directive that would allow for a variation or a reduced deduction of pay as you earn. In that case, the application must be made by the employer, and foreign employers may also apply, but only if they have a representative employer in South Africa. Importantly, where the employer submits the application, they must do so with a motivation of why it should be approved, with a proposed method and reasoning for the proposed pay-as-you-earn withholding. An important note is also that SARS will not consider an application for a hardship directive where the employee's remuneration is below the threshold, the remuneration is fully exempt, or where the remuneration is not taxed in the host country, or where the application relates to a previous year of assessment. And this is probably also, especially when we get questions from corporate clients, is how to deal with the amendment from a payroll perspective. And obviously the question that arises there is, does the employer have an obligation to withhold pay as you earn? And the general rule is here that if the employer is a resident, or if they have a representative employer in South Africa, there will probably be an obligation to withhold, depending on how much the employee earns in remuneration. Where the employer is non-resident with no representative taxpayer in South Africa, there would be no obligation to withhold pay as you earn, irrespective of the tax liability or irrespective of the fact that the employee satisfies the days requirement or not. And if that is the case, the employee must register as a provisional taxpayer, and any liability must then be settled with provisional tax payments. So in some cases where the employer does not have an obligation to withhold, they ask the question if they should set up an expatriate payroll to cover the pay-as-you-earn obligation. And our view generally is that this should probably be avoided, because it is quite difficult to establish and run a fully compliant expatriate payroll, especially if you consider the calculation of in-country fringe benefits and allowances. You have to deal with exchange rate conversions. You will also then, as we discussed now, probably have to consider 6 quad credits and administering hardship directives if the employee is subject to double taxation. So our general advice would always be to avoid it if you can. Now, if the employer is resident or has a representative employer in South Africa, there may be an obligation, and that will depend on the amount of remuneration earned by the taxpayer and if it is anticipated that the employee will satisfy the underlying requirements, specifically the days test. And in this regard, it's important to consider the definition of remuneration, which is derived from the defined term income. So, and that is derived from the term gross income. And income, as we know, is gross income less exempt income. So in other words, if the employee's entire gross income would be exempt under Section 10102, there would not be any amount of remuneration, and the result is there is no obligation to withhold employees' tax. So if the employer is confident that the employee will meet the days test and that their entire remuneration will be exempt, they can still decide not to deduct any pay-as-you-earn. Where the employee earns above the threshold and it is clear that there will be a withholding obligation, it's important to remember that the exemption of 1.25 million rand cannot be spread over the year of assessment. In other words, there is no proration. The obligation to withhold pay-as-you-earn only kicks in during the month when the 1.25 limit is exhausted. So you have to aggregate all remuneration items, including fringe benefits and allowances, up until the point where the 1.25 is depleted. And in that month, you need to start withholding your pay-as-you-earn. And just as a general point, if there's any uncertainty that the requirements will be satisfied, especially given what we are dealing with in COVID now and with potential future lockdowns, hopefully not, but in that case, it's best to take a conservative approach and withhold pay-as-you-earn. And then in the same context of the exemption, there is an interesting item that came about last year. It was not in the 2020 tax bills, but there was unexpected relief provided to account for the time that South Africa was in levels 4 and 5 of lockdown, where the aggregated days requirement was reduced. And in terms of the application, it's not that complex, but there is an item where we've seen there is potential confusion. So the aggregated or the first leg of the days test is reduced by 66 days, which means that you only need to spend 117 days outside of South Africa as opposed to 183. And this only applies for years of assessment 2020 and 2021. But there has been a question also under ordinary circumstances, as we know, the section refers to any 12-month period during the year of assessment, which means that the taxpayer can choose or select any 12-year period that overlaps with the applicable year of assessment, and they are allowed to use more than one period. Now, the question came about if this, what they call double dipping, still applies to the COVID relief measure. In other words, can you still use a 12-month period that stretches beyond the 2021 year of assessment or before the 2020 year of assessment? And there is a view that the 117 days must be exhausted by the close of the 2021 year of assessment. In other words, your 12-month period cannot stretch beyond that time. Our view is that if you read the old section, if I can call it that, with the amended section, the wording is exactly the same. So it does allow you to still utilize any 12-month period beyond or before the 2020 or 2021 year of assessment, as long as it overlaps to an extent with that year. So in essence, what you can, the double dipping principle applies under the reduced days test as well. And this brings us to the new immigration process after, which commenced on 1 March of this year. And this came about by the amendment to the definitions of pension preservation fund, provident preservation fund, and retirement annuity fund. And it removes the reference to the process through the South African Reserve Bank. And it was replaced by a new test where the taxpayer can only withdraw their retirement interest where they can show non-residency for an uninterrupted period of 3 years. Now, the question is, or what we often get asked is, what's the difference practically in terms of the old process and the new process? Because in a lot of aspects, it feels like it's more or less the same. So what I've done is I've summarized the key differences between the processes on this slide. In terms of the old process, you would have submitted the MP 336B form with your application. There was a requirement for an authorized dealer to attest to the application. And SARB would have to sign off on the process before it concludes. And it came with certain archaic restrictions on your bank account and how you conduct your banking after you've finalized the process in South Africa. And if we look at the new process, this is more focused on a SARS process, and it deals with your tax residency more than anything else. And it involves an application for an immigration tax clearance PIN. It also, the process is centered around your draft exit tax calculation that you need to submit and which will be vetted by SARS quite stringently. And that also brings in the audit process. What we've seen is there's a lot more oversight. They ask quite onerous questions in some cases, especially if the taxpayer's facts are quite complicated. And yeah, before your authorized dealer will be permitted to expatriate any of your funds, SARS would have to approve the whole process and issue you with that PIN. In looking just at a couple of notes regarding the new process, as we know, you can still, or old applications were still accepted if they were submitted by 28 February 2021. Some have asked questions if that means that the process must have been concluded by that time, but that certainly is not the case as long as your application was complete and submitted by that date. As I mentioned, the focus on this in terms of this process is residency. And we have actually, interestingly enough, seen SARS question motivation for where the taxpayer advocates for a specific date of cessation, especially if their facts are convoluted or where the taxpayer would return after that date. And what we've seen best, or what works best in this case, is if you get an independent residency opinion. We've not seen SARS challenge those if we submit that with the application. And in dealing with the audit of this process, our advice would be to assess the full profile of the client before you initiate the process, because we've seen some very interesting questions, and we'll get to that in a moment. So it's best to do your due diligence before you commence the application process. And before we look at specific audit questions, from an exchange control perspective, there was some confusion because which came about after government's announcements in the budget speech last year, where they said they'll phase out the distinction between residents and non-residents for exchange control purposes. At the moment, that distinction still remains extant. So there is still a distinction. And if you look at the authorized dealers manual and the exchanges manual, most of the exchange control provisions are exactly the same. And as far as I know, they are working on a framework at the moment, but it's not quite clear when that will be finalized or what that will involve. Just looking at some examples of the questions that we've received when dealing with this process, it can range from anything where SARS asks for a reconciliation of bank statements to a CV of the taxpayer to explain how they made their money. They have asked for persons to clarify who invested their money, where they invested their money, explaining what their roles are in relation to certain companies, and specifically also trusts, particularly where they are foreign trusts. They also have a very careful look at your exit tax calculation. And that's also why they ask for, I think, 3 years as statement of assets and liability, and they go through that in quite a bit of detail, especially if the client's profile is fairly integrated. There are just some more questions there. They also ask for foreign residency certificates and the right to reside in other countries to pinpoint the date where you cease your residency. And if you do not have that, they would give you quite a bit of difficulty during the process. As you can see there on the right-hand side, I believe this is where they asked for the person's, what is the person's occupation or occupational background, which you can then address by submitting a CV, which we found quite interesting. And then moving on to the proposed new exit tax. So this section is still in draft. It's not yet been enacted, but what government intends to do is to insert a new section 9 cap H cap C, which triggers a tax on retirement interests when a person ceases residency. The tax is triggered on the day before the person ceases their residency, but the actual payment of the tax is postponed until the benefit becomes payable from the fund. The section is drafted quite awkwardly, but it looks like from what we can glean from the explanatory memorandum is that the postponed tax will be incurring interest from the day that it is triggered until the date of payment, which is also quite onerous. And just looking at a couple of notes, as I mentioned, it's not yet promulgated. And actually, I believe that this amendment was opposed quite widely, especially if you were present at the parliamentary sessions. Everyone says that this proposal it cannot be introduced, at least not yet. We'll need more time. And it will be interesting to see what SARS and National Treasury and in how they deal with those submissions. And I believe that the response document that they'll compile will be issued with the medium-term budget speech, which will be this Thursday. So it will be interesting to see the lay of the land there. Just some other notes. We believe that this proposal will constitute South Africa's first treaty override, especially in where the treaty allocates the sole taxing right to the country of residence. I believe that we have a couple of those treaties. The knock-on effect of that will be where the taxpayer is subject to double taxation, which will likely be the case. We don't foresee that they'll be receiving any relief from their new country of residence or from South Africa. So I'm not sure how that will be dealt with. Stakeholders have also raised the fact that fund rules will have to be amended, in addition to peripheral and other key pieces of legislation, including the Tax Administration Act. Otherwise, this proposal will not be able to be accommodated. So I think, in my view, at the very least, this amendment will have to be postponed. But let's wait until Thursday to see what happens there. And then I've made a brief note of a couple of other amendments that are also addressed in the book. We unfortunately do not have time to run through all of those. What is interesting is the new provision or the amendment to Section 8 of the Income Tax Act, which deals with allowances for day trips. I would also encourage people to look at how SARS deals with allowances, not just this one, but in general, in their interpretation note 14, and also SARS's guide on allowances. We also do discuss this in quite a bit of detail in the book. Of course, we know that retirement reform took effect from 1 March 2021, which is also a very important amendment. And unfortunately, that will be a webinar on its own. We've dealt with the COVID relief measure under the foreign employment exemption. There is a part in the capital gains tax chapter in the book where we discuss the taxation of crypto assets, which is becoming more and more prominent. Then we've added a lot of content to the tax administration chapter. There has been a couple of amendments there that I think is important, particularly the one to the criminal provisions and what that would mean, not just for the individual taxpayer, but for a person that is, such as an employer, that is responsible for withholding. In terms of work permits, there is an update on the critical skills list, which was unfortunately not yet finalized by the time that the book went to print. And we also explain what the current status is of exchange control after the phasing out of the immigration process through the South African Reserve Bank. I think that it clears up a lot of confusion in that regard. And then there were several cases since the publication of the first edition. Most of these were actually published, I think, during this year. Looking at a couple, the carte blanche case deals with when or which decisions you can take on review. Specifically, it was noted that a decision to review a taxpayer cannot be reviewed as administrative action. Telkom is an important case from an interpretive perspective, including the contra fiscum principle. The exclusive books case deals with severance benefits, and that's quite an interesting case if you want to go and read that. Perry Formwork deals with the imposition of administrative penalties and the grounds that you need to put forth if you want to remit those. Absa Bank looks at when a taxpayer can approach the High Court directly to challenge an assessment. Then there are several cases dealing with SARS's collection powers and when they overstep, particularly if they sweep taxpayers' bank accounts. Purveyors and Medtronic looks at VDP, which is also now included in the tax administration chapter, which was previously not dealt with. And Rapper Resources is not a new case, but I think it's a very interesting case for taxpayers if they want to understand how SARS deals with refunds and when SARS can withhold the payment of a refund and the permutations in that regard. I think for everyone, that's a very good case to read. And yeah, I think that brings us to the end of the presentation. I think if we'll deal with the questions, the Q&A session now, but just as a general point, if anyone has specific questions that we cannot address now, you are most welcome to send me or any of the other panelists an email. We do have a professional partner network where we assist other practitioners in dealing with certain specific questions around expatriate taxation. So yeah, anyone with more in-depth questions are more than welcome to pose them or to send us an email afterwards. I think our details will be put up at the end of the slideshow. I think I'll hand over to Dylan now to get us into the Q&A.
Thank you, Jean. That was really insightful. As you said, there is a lot more detail in the book. The book will be available from the 12th of November. And as you can see on the e-store, we are open for back orders and we've got a 15% discount running as an early bird special. So you can back order the book. We'll now open the floor for questions. So please use the Q&A tab at the bottom of the screen. We'll now hand over to Thomas and Dylan, who will facilitate the Q&A. Thank you.
Thank you, Sarah. Thanks, Sean. And thank you for the opportunity for everybody taking the time to join the webinar. Before we jump into the Q&A, I'd like to just ask Josie to share the Q&A results. Obviously, we just want to get a feel for the audience that we have on here today. And that'll also direct some of the questions and the manner in which we need to ask, or rather the manner in which we need to answer in terms of technical depth. We have quite a lot of people on the call, but we encourage you, we have finished a little bit early, so there's about 20 minutes left. If you have any questions, please pop them in now. But before we raise the first one, just a bit of introductions. My name is Dylan Price. I'm the Chief Marketing Officer for Tax Consulting, and Thomas Lobben is the Legal Manager for Cross-Border Taxation. So we'll try our best with Sean to answer any questions that come through. But before we proceed, we've got the results up in front of you. If anybody's got technical difficulties to see the results, please pop them in the chat section. First question, we specifically asked, did you purchase the first edition of the LexisNexis Expat Tax textbook? Surprisingly, 7% said yes, 93% said no. So we've got a couple of newbies to the book and how the book is set out. If anybody's ever seen the book, it's quite daunting. As Sarah said, 900 plus pages. I encourage you, if you are going to pre-order online, go and have a look. It's really worth the reading. What we found interesting last year when we traveled to the Middle East to present on this particular topic, that we even had individuals asking for copies of the textbook. But it's definitely not for bedside reading. There's a lot of tax technical content in the book. But what is really nice is that Sean and the writing team have added a lot of practical examples. But then in terms of on the call, if anyone already assists clients with expat services, 55% said yes, 45% said no. So Jean, I think we've got quite a blend here of people that maybe are being introduced to expat tax for the first time or wanting to improve their knowledge on this area. And I think that's fantastic, especially for the 45% that said no, to gain a bit of extra knowledge. And I think that's the whole purpose of this webinar and the book, as well as the professional partner network, is to just share knowledge with fellow professionals and the industry. So perhaps that should guide you in terms of answering the questions, maybe just touching up on some of the basics and not too technical. Then finally, we just asked intentions for attending the webinar. 15% said on behalf of clients, 20% said on behalf of my company, 8% said for personal reasons, and there 57% to expand my knowledge on expatriate tax. So that's good to know. So without further ado, I think I'm going to just start from the top. The first question we've got from Francisca. And Jean, Tom, you guys can jump in at any stage just to deal with it specifically. One of my clients has immigrated to Germany, but he's still employed by a South African employer. He will spend max 1 month per year in South Africa, which is on holiday. How do I deal with him from an SA payroll point of view? Jean, you're on mute.
Sorry about that. So in that case, if it's the employee is paid from a South African company, which would then be a resident. So your point of departure is that there would be a withholding obligation. It looks like he spends at only 1 month in South Africa. So my presumption is that this person will satisfy the days test. In other words, the 183 and the 60 days consecutive. So I think it will come down to the amount of remuneration that this person earns. If it's clear that he earns far below the 1.25 million, then they might not, it's within the employer's discretion not to withhold employees' tax. If it is closer to the 1.25, it's probably best then to adopt a conservative approach and to ready yourself for withholding obligation. But as I mentioned earlier, the obligation will only kick in at the point where the aggregated remuneration has exhausted the 1.25 million limitation. So to answer your question, generally, I do think that there might be a withholding obligation depending on what the person earns.
Thanks, Sean. I think that's pretty clear. And Francisco, like we said, if you have any follow-up questions on that, please feel free to send us a mail after the event. I'm continuing down the list. Another question: if a foreigner earns commission from a SA company, but the person does not live in SA, a non-resident, must they still pay provisional tax in SA?
Okay, so in that case, well, the first thing that I would look at is, remember the foreign employment exemption only applies to certain amounts. It must be an amount of remuneration, not as defined, but it must be an amount paid in respect of an employment relationship. So it's important to first look at if the commission arises from an employment relationship, and if it does, then again, we have to apply the same principles. So it is a South African company, which will be a resident. And then we need to look at, again, it looks like the person will satisfy the day's test, but then the ultimate question of withholding would be determined by the amount that this person earns. But in this case specifically, I would just look at the employment contract to see if the amount actually qualifies for the exemption in this case.
Thank you for that answer, Jean. The next one seems to be a bit more administrative in nature. Do we deduct the 1.275 from remuneration, or do we enter the total remuneration in the tax return?
Okay, so if I understand it correctly, the question is if the limitation is deducted from the amount. So as far as I know, because the exemption applies to South African residents, you still need to disclose your full income. So you disclose what the person earns in total, and you then need to claim the exemption. So if you want to claim the full exemption, you disclose that this person earns, for example, 3 million rand, and you then note that the tax liability is only in respect of the balance, but you'll have to disclose the entire amount. SARS still needs the opportunity to assess if you validly qualify for the exemption, if that makes sense.
Thanks, Sean. Another one, and we're getting a little bit technical here. So like we said, we can obviously unpack this a bit more with the attendees after the call. But Sean, based on the limited facts, I think maybe answer as best as you can, and we can always dig deeper after the call. Another attendee said, if the employer is UAE based with employee based in South Africa without being a registered company in South Africa, what is the tax obligation to the employee being a resident in South Africa but working for the client in the UAE?
Okay, well, in that case, it looks like the UAE-based company would not be a resident. And if we accept that it doesn't have a registered company in South Africa, it probably will also not have a representative employer in South Africa. So in this case, there would be no obligation on the UAE company to withhold pay as you earn. And seeing as the employee is a South African tax resident, they will have to register as a provisional taxpayer and settle their taxes on that basis.
Thanks, Sean. And then I think this one can also maybe further on to that question, but I'll also rope Tom in on this one. My client is currently employed overseas. He has a residency certificate from the UAE. How do I submit his ITR 12 so that he isn't taxed in South Africa? Will he be exempt in total in SA because of his residency certificate in the UAE? The option for the ITR 12 form, should I complete the form for the exemption? He hasn't sold any properties as his wife is still a resident in SA. So Tom, I already see a couple of nuances to this case. I don't know if you want to give just an initial view, but I think this requires a bit of deep digging just based on some of those facts given.
Agree. Thank you, Dylan. Definitely, this will be something that we need to look further into in order to fully advise. The tax residency certificate is definitely a requirement to be able to apply the tiebreaker test in terms of further than a tax residency certificate, the client will still need to satisfy the requirements of the tiebreaker test in favor of the UAE, not having a permanent home in South Africa as compared to the UAE, or if so, having their personal and economic relations being closer substantially in the UAE versus South Africa. So this is something, knowing that the spouse is still resident in South Africa, we might read that as she's still residing in South Africa. Off the cuff, I'd say perhaps DTA, non-resident relief, isn't available, but certainly the Section 10102 requirements might be met, and if so, that would be up to 1.25 million rand per tax year that the client may be able to have exempt from tax in South Africa. Because the UAE is a zero tax jurisdiction, they don't impose personal income tax. If they're earning above 1.25 million rand in gross employment income abroad, they may still have a liability in South Africa that would need to be settled.
Thanks, Tom. And like we said, we can unpack that a bit clearer afterwards if need be with more facts given. Another one from Kelly: if a client has worked in Burkina Faso, which has no DTA, qualifies for Section 10(1), will the tax deducted still qualify here in his SA tax return for Section 6 quat?
Yeah, I think, well, Tom can correct me if I'm wrong, but I do believe that despite the fact that there is no DTA, you will still be eligible for a credit under Section 6 quat.
Cool.
Just to add to what John is saying, it would need to be a similar tax to that would be imposed in South Africa. Otherwise, absolutely correct.
Great. Then another one also from Alfie: I have clients working in Australia. They have not immigrated. Do I first establish if they are exempt according to the double taxation agreement? If not, then Section 10102. How do I establish that they qualify according to double taxation agreement? Steps to take. And I think, Tom, this works quite closely in what we assist in the professional partner network, just starting right at the beginning with the facts and the tax diagnostic. Perhaps you can just give a slight view in terms of how we would go about unpacking that. And it might just give Alfie a bit more of an informed decision-making process.
No problem at all. Firstly, as you mentioned, the tax diagnostic, we would want to see their history, how long they've been in Australia, and the fact that declaration date. Further than that, we'd look at their circumstances to first see if DTA relief is required in the first instance. It may be that the client fully intends to return to South Africa since they haven't immigrated. And so earning employment income under 1.25 million rand, or at least with a degree of tolerance over that with a tax credit proportionally applied afterwards, they have no tax liability in South Africa or minimal tax liability. Further than that, if they're going to be staying in Australia for a significant enough amount of time, or they're earning a high enough income, or they're not an employee, cannot qualify for Section 10102, or it's insufficient, we would then look into their circumstances in Australia versus South Africa to see if the tiebreaker test per the DTA would provide the relief that they require. If they don't intend to return to South Africa, and that's something that can be substantively proven, then we may look into financial immigration, permanently ceasing their residency in South Africa, make that declaration and formalize their immigration.
Thanks, Tom. We do still have quite a few questions open. Sarah, I know we do have time, but a lot of the natures of the question may require a bit of deeper unpacking. I'm wondering if we're allowed to maybe take one more question, Sarah, and then anyone that are open, if we can just then send a note to the attendees afterwards, just with our view.
Absolutely. You've got until 5:02.
Okay, great. So I think let's just raise one more quickly. Jean and Tom from Shonay, 2 questions. A client of mine lives in SA and works as an estate agent for a SA employer and pays payee. She owns a property in Namibia and earns rental on it. Namibia works on a source-based income, so she's registered there for tax, but her rental profit is below the tax threshold, so no tax is paid. Must she declare the rental income of Namibia in SA as foreign rental income? I think she should.
Yeah, so purely on the basis, I'm assuming that your client is resident. So as a point of departure, she is required to disclose her worldwide earnings and is subject to tax on that. I believe in any event, with if the double tax treaty would allocate taxing rights to both South Africa and Namibia, but in any event, he or she would be required to disclose that rental income in her return.
Thanks, Sean. And then just the last one before we close off, unless you want to add something to that.
No, that's it. I do see that. I don't know if we've missed this question from Erin regarding the formal valuation of shares.
Yeah, you can go for it.
Sorry, we can get to the other one now. That's quite an interesting question. The valuation of private company shares is I mean, so the exit tax works on the basis that it's market related. So you can always argue that what would the person, what would a willing buyer, willing seller pay for the shares? But SARS might, depending on what the company does and what types of assets it does have, it would prescribe certain methods of valuation. So there's no a general answer to that. It really depends on what the company does. Obviously, for example, if it's a property holding company, they would look at the valuation of the underlying properties. If it's not an asset heavy company, if I can call it that, they would look at the earnings of the company, or they might look at the net asset value. As long as you can, I think, motivate why you put forth that valuation, I think you can sort of, I don't want to use the word choose, but select an appropriate method to support that. Dylan, then that's Shaunae's second question, right?
Yes. Do you want me to read it for you? So the second question, a client who's an independent contractor earns income from a foreign income as her only income. The foreign employer is not registered as an employer in SA. I don't want her to claim trade expenses against her income due to the employee-employer relationship implied by that being her only full-time income. She works from home in SA full-time.
I see. Okay, well, as a point of departure, where she is an independent contractor, she does not qualify for the foreign employment exemption. As I said earlier, the amounts that are subject to the exemption must be paid in respect of an employment relationship. But then you also note there that there might be an employer-employee relationship. So I think in that case, it's best to assess the underlying contract between the parties to determine what the true nature of the relationship is. Obviously, I would say that it is probably in the best interest of your client to claim the exemption if she can, but you'll have to look at the underlying documents to see what is in substance what the situation is. If she is an independent contractor, the exemption would not find application to her, but the registered company in South Africa, because she's an independent contractor, if she's a non-resident independent contractor, the company would have an obligation to withhold. If she is a South African resident independent contractor, there is no withholding obligation because a person conducting an independent trade is excluded from the definition of remuneration. But so in essence, if we accept that she is an independent contractor, the obligation to withhold would be dependent on her residency status. If she is resident, there is no withholding obligation, but if she is non-resident, the company would have to withhold. I hope that answers your question.
Yeah, quite a technical one, Sean, but I think that's the nature of expat tax and the reason why we've started this webinar. And Sarah, thank you for you and your team for setting this up, and also for all the attendees. I know there's a lot of open questions, but we just have kind of run out of time. So we're happy to to sort that out after the webinar. But thank you everyone for your patience, and sorry we couldn't get to everything now. But Sarah, over to you, and thank you from our side, really. It went well.
Thank you, and thanks everyone for your questions. We will answer those and distribute them together with the webinar recording within a few days. And then to those of you who are wanting to claim CPD points, to obtain your certificate of attendance, please just look out for an email from us a few days after this event, which will give you a unique login and password to go onto our online training platform, and you can download your certificate. Please just note that sometimes it goes to junk or spam, and that the spelling of the names on the certificate will be exactly what you typed in when you registered for the webinar. And then just from our side, thank you once again to Jean, to Dylan and Thomas for sharing your insights and expertise with us. And thanks to all of you for joining us to celebrate the launch of the second edition. As I mentioned, if you haven't already ordered, please do so before the 15th of November if you would like to take advantage of the early bird discount. It is in the chat. The e-store address is in the chat, and you have to enter Expat 15 on checkout. Thank you once again. We hope you found our session useful, and we look forward to connecting with you again soon. Thank you.